Ladies and gentlemen, most people think the biggest story in gold is what the Federal Reserve does. They're looking in the wrong place. Right now, something much bigger is unfolding in China. And if you own gold or silver, or you're thinking about buying, this could reshape the entire precious metals market. This isn't about hype or fear. It's about understanding the global shift before the headlines catch up. In the next few minutes, I'll explain what's happening, why it matters, and what smart investors should be watching. When most people look at the price of gold, they're focused on the daily chart. They watch the price tick up a few dollars, then down a few dollars, and they try to figure out what caused the latest move. But the real story in precious metals isn't found in the daily price action. It's found in the decisions that are made quietly, consistently, and over many years. That's where the biggest trends begin, and those are the trends that long-term investors should pay attention to. One of the most important developments in the global financial system has been the steady accumulation of gold by major nations. This isn't a reaction to a single economic report or a temporary market event. It's part of a much broader strategy that reflects how governments and monetary authorities are preparing for a changing financial landscape. These institutions operate on a completely different timeline than most investors. They're not worried about what happens next week or even next quarter. They're thinking in decades. Gold has always occupied a unique position in the monetary system. Unlike paper currencies, it isn't created by government decree. It doesn't rely on the financial health of a single nation or institution. It carries no counterparty risk when held directly, and that quality becomes increasingly valuable during periods of uncertainty. That's one reason why central banks around the world have become some of the largest buyers of physical gold in recent years. This isn't speculation. It's a shift in asset allocation. When institutions responsible for managing national reserves choose to increase their gold holdings, they're making a statement about the importance of diversification and financial resilience. Gold serves as a form of monetary insurance. You hope you never need that insurance, but it's reassuring to have it when conditions become unpredictable. Another point that's often overlooked is the scale involved. When a large nation adjusts its reserve strategy, the volumes are significant. These aren't small retail purchases. These are transactions that can influence long-term supply and demand dynamics. Gold production doesn't suddenly expand because demand increases. Mining is a slow, capital-intensive business. Bringing a new mine from discovery to production can take many years, sometimes more than a decade. That means new supply simply cannot respond quickly when demand accelerates. At the same time, high-quality gold discoveries have become increasingly difficult to find. Ore grades have generally declined, production costs have risen, and permitting new projects has become more complex in many parts of the world. All of these factors place natural limits on future supply growth. So when sustained institutional demand enters the market, it creates an environment where the available physical metal becomes increasingly valuable over time. It's also important to understand that gold isn't replacing modern finance. Rather, it's complementing it. Nations continue to hold currencies, government bonds, and other reserve assets. Gold simply represents an asset that exists outside the promises of governments or financial institutions. In an increasingly interconnected world, diversification has become more valuable, not less. For individual investors, this provides an important lesson. The largest players in the financial system aren't treating gold as a speculative trade. They're treating it as a strategic reserve asset. That's a very different mindset. Instead of asking whether gold will be 5% higher or lower next month, they're asking what role it should play over the next 10 or 20 years. History provides plenty of examples of why this approach matters. Financial systems evolve. Reserve currencies change over time. Economic leadership shifts between nations. Throughout all of those transitions, gold has maintained its purchasing power far better than many paper currencies that eventually disappeared or lost substantial value through inflation. That's one reason it has remained relevant for thousands of years, despite enormous technological and financial innovation. Another factor worth considering is confidence. Every monetary system ultimately depends on trust. As long as people have confidence in institutions, markets function smoothly. But confidence isn't constant. It rises and falls based on economic conditions, fiscal discipline, geopolitical developments, and public perception. Gold has historically served as an anchor during periods when confidence weakens. That doesn't mean the price moves in a straight line. It never has. Gold experiences corrections, periods of consolidation, and even multi-year bear markets. That's completely normal. Long-term investors understand that volatility is part of every asset class. The key difference is focusing on the underlying fundamentals rather than allowing short-term price fluctuations to dictate long-term decisions. It's also useful to separate the physical market from the paper market. Futures contracts, options, exchange-traded products, and other financial instruments often create significant short-term volatility. But physical demand reflects something much more tangible. When institutions, investors, or nations choose to acquire and hold actual bullion, those ounces are removed from readily available supply. Over time, sustained physical demand has the potential to influence broader market dynamics in meaningful ways. For anyone building wealth over the long term, the message is relatively straightforward. Precious metals shouldn't be viewed as a get-rich-quick opportunity. They represent financial insurance, portfolio diversification, and protection against risks that are difficult to predict but impossible to eliminate entirely. The goal isn't to abandon other investments. The goal is balance. Markets will continue to fluctuate. Headlines will continue to change. Analysts will debate interest rates, inflation, currencies, and economic growth. Those discussions are important, but beneath all the daily noise, the larger trend deserves attention. When major financial institutions consistently increase their exposure to physical gold over many years, they're revealing how they view long-term financial risk. That's information every investor can learn from. Ultimately, successful investing isn't about reacting emotionally to every headline. It's about recognizing structural changes before they become obvious to everyone else. Gold has played a monetary role for thousands of years because it solves problems that no paper asset can completely eliminate. As the global financial system continues to evolve, that role appears to be gaining importance rather than fading away. For patient investors who understand the difference between short-term market noise and long-term monetary trends, that's a development worth watching very closely. When investors think about what moves the price of gold and silver, they often focus on interest rates, inflation reports, or the latest comments from central bankers. Those factors certainly matter, but they don't tell the entire story. The precious metals market is global, and some of the most important drivers develop gradually, often outside the daily headlines. Large economic shifts, changes in financial policy, and evolving investment behavior can have a lasting impact on demand for physical metals. One of the key principles to understand is that economic uncertainty changes the way people think about preserving wealth. During periods of stability, investors tend to favor assets that promise growth or income. Stocks, corporate bonds, and real estate often receive the majority of attention because confidence in the economy encourages people to take on more risk. But when uncertainty begins to increase, priorities start to change. Instead of asking how to maximize returns, investors begin asking how to protect the wealth they have already built. That shift in mindset is one of the strongest long-term drivers of precious metals demand. Gold has traditionally served as a store of value during uncertain times, while silver benefits from both investment demand and its essential role in modern industry. Together, they occupy a unique position because they combine monetary history with tangible physical value. Economic stimulus is another factor that deserves careful attention. Whenever governments or monetary authorities introduce measures designed to support economic activity, they increase liquidity within the financial system. While those policies may help stabilize growth in the short term, they can also raise concerns about future currency purchasing power. Investors who worry that paper money may gradually lose value often look for assets that cannot be created in unlimited quantities. Physical gold and silver naturally become part of that conversation. This isn't because precious metals produce income or dividends. They don't. Their strength comes from scarcity and durability. An ounce of gold remains an ounce of gold, regardless of monetary policy, political changes, or economic cycles. That consistency has made it a trusted form of wealth preservation across generations. Silver deserves equal attention, although for somewhat different reasons. While it shares gold's monetary characteristics, it also plays an essential role in manufacturing renewable energy, electronics, medical equipment, and many advanced technologies. As industrial activity expands, silver demand can increase independently of investment demand. When both forces begin working together, the market can tighten much faster than many investors expect. One of the realities of the silver market is that it is significantly smaller than the gold market. Because of that, relatively modest increases in investment demand can produce disproportionately large price movements. Silver has historically been more volatile than gold, moving sharply in both directions. That volatility can be uncomfortable, but it also reflects how sensitive the market is to changes in supply and demand. Another important consideration is consumer behavior. In many parts of the world, physical precious metals are deeply integrated into personal savings habits. Families often purchase gold and silver, not simply as investments, but as a form of long-term financial security. That cultural demand provides an additional layer of support beyond institutional investment. It represents millions of individual decisions that collectively create substantial physical demand over time. Cart trading movements also deserve attention. Whenever investors become concerned about the future purchasing power of their domestic currency, demand for hard assets often increases. Gold and silver have historically served as alternative stores of value because they exist independently of any single nation's monetary system. They don't depend on government promises or corporate earnings. Their value comes from scarcity, universal recognition, and thousands of years of monetary history. It's important to remember that demand doesn't always appear suddenly. Markets often move through stages. Initially, institutional buyers begin increasing allocations quietly. Later, professional investors recognize the trend. Eventually, retail investors notice stronger prices and growing media attention. By the time a trend becomes front-page news, much of the underlying accumulation has already taken place. That's why experienced investors spend more time studying fundamentals than headlines. They ask whether physical demand is increasing, whether mine production is keeping pace, and whether long-term monetary conditions are becoming more supportive for precious metals. These questions provide a clearer picture than simply reacting to daily price fluctuations. Supply constraints add another layer to the discussion. Mining companies cannot rapidly increase production whenever prices rise. Developing new projects requires exploration, environmental studies, financing, construction, and years of operational planning. Even if demand accelerates quickly, supply usually responds much more slowly. This creates the potential for prolonged periods in which demand outpaces available physical metal. Gold and silver markets are also influenced by investor psychology. Confidence tends to move in cycles. During optimistic periods, investors often underestimate risk. During uncertain periods, they sometimes overestimate it. Precious metals frequently perform their most important role when confidence begins to weaken because they provide diversification that many traditional financial assets cannot offer. This doesn't mean precious metals rise every time economic uncertainty appears. Markets are rarely that simple. Prices are influenced by numerous factors simultaneously, including interest rates, currency strength, futures trading, and overall investor sentiment. Short-term volatility should be expected. The key is recognizing that temporary price movements don't necessarily change the long-term structural trend. For individual investors, the lesson is straightforward. Avoid becoming overly focused on daily headlines or dramatic predictions. Instead, pay attention to the broader economic environment. Observe how governments respond to slowing growth, rising debt, changing trade relationships, and evolving financial conditions. These larger developments often shape precious metals markets far more than a single economic report. Successful investing requires patience. Gold and silver are not designed to outperform every other asset in every year. Their purpose is different. They provide balance within a diversified portfolio and help preserve purchasing power through changing economic cycles. They act as financial insurance against risks that cannot always be predicted in advance. Over time, sustained economic uncertainty, supportive monetary policies, increasing physical demand, and constrained mine supply can create an environment where precious metals become increasingly attractive to both institutional and individual investors. Those trends don't unfold overnight, and they rarely receive widespread attention until they are well established. Investors who understand these structural forces are often better prepared to navigate changing market conditions with confidence rather than emotion. In the end, precious metals are less about chasing quick profits and more about understanding the long game. Markets will continue to rise and fall, economic conditions will evolve, and policies will change. But the fundamental reasons people turn to gold and silver during periods of uncertainty have remained remarkably consistent throughout history. That consistency is exactly why experienced investors continue to monitor these markets so closely, focusing not on the noise of the day, but on the enduring trends that shape the future. After looking at the broader economic picture and understanding why precious metals continue to attract long-term attention, the next logical question becomes very simple. What should investors actually do? That's where discipline matters more than excitement. The biggest mistake people make is believing they need to predict every market move perfectly. In reality, successful investing is rarely about perfect timing. It's about making sound decisions consistently and allowing time to work in your favor. One of the most important principles is to think like a steward of wealth rather than a trader chasing headlines. Markets move every day. Prices rise, prices fall, and financial news often makes those movements seem much more significant than they really are. It's easy to become emotionally attached to every fluctuation, especially when gold or silver experiences sharp volatility. But if your investment thesis changes every time the market moves a few percentage points, then your strategy probably wasn't built on solid foundations in the first place. Gold and silver have always experienced periods of volatility. That isn't a flaw in the market. It's simply the nature of relatively small asset classes responding to changing economic conditions. Investors who understand this are less likely to panic during corrections and less likely to become overly enthusiastic during rapid price increases. They recognize that long-term wealth is usually built through patience, not constant activity. Another key concept is diversification. Precious metals should not necessarily replace every other investment you own. Instead, they can serve as one component within a balanced portfolio. Different assets perform well under different economic conditions. Stocks may thrive during periods of strong economic growth. Bonds may provide stability under certain market environments. Real estate has its own characteristics. Gold and silver offer something different. Protection against monetary uncertainty and diversification when traditional financial assets face challenges. That balanced perspective is often overlooked because people tend to think in extremes. They either believe precious metals should represent nearly all of their investments or none at all. History suggests a more measured approach usually serves investors better. Diversification is not about predicting which asset will perform best every year. It's about reducing overall portfolio risk while maintaining exposure to multiple opportunities. Another lesson worth emphasizing is the difference between owning physical precious metals and owning financial products linked to their prices. Exchange-traded funds, mining stocks, futures contracts, and other investment vehicles all have legitimate roles depending on an investor's objectives. However, physical bullion occupies a unique position because it carries no counterparty risk when held directly. It isn't someone else's promise to pay. It is the asset itself. That distinction becomes particularly important during periods of financial stress. Financial markets function because participants trust that contracts will be honored and obligations will be fulfilled. Most of the time, that system works remarkably well. But one reason investors hold physical gold and silver is because they exist outside that network of financial promises. They represent tangible assets that have maintained value across generations, regardless of changing political or economic circumstances. Storage and security also deserve thoughtful consideration. Owning physical metals means taking responsibility for protecting them properly, whether that involves secure home storage, professional vaulting services, or other arrangements depends on individual circumstances. The important point is recognizing that preserving wealth includes protecting the assets themselves. Another mistake investors often make is focusing exclusively on price targets. Questions like, how high can gold go, or will silver double next year, are understandable, but they can distract from more meaningful analysis. A better question is whether the long-term reasons for owning precious metals remain intact. Are governments continuing to accumulate debt? Are currencies gradually losing purchasing power over time? Are geopolitical uncertainties increasing or decreasing? Are mine supply challenges becoming easier or more difficult to overcome? These are the types of questions that help